When you open a chart, what is the first thing that catches your attention? Today, we're diving into the art and honestly the science of mastering swing trading. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. And to really get our heads around this, I want you to picture a pro surfer. If you've ever watched surfing, you know they don't waste their energy frantically paddling around in the chaotic, choppy white water right near the shore. No, they sit further out. They're calm, they're disciplined, and they patiently wait for that perfect high-probability wave to roll in. Well, that is exactly the mindset we're going to adopt today. We are not here to fight the daily market noise. We're here to catch the most predictable waves. Are you just too busy to day trade? Because let's be real, that's the #1 reason people start looking into swing trading. If you're a working professional, or maybe a retail investor with a packed life, you simply don't have the time to sit there glued to a monitor staring at minute-by-minute charts and stressing out over every tiny price flicker. You know, you want the potential for active market returns, but you absolutely need a strategy that fits into your life rather than totally consuming it. So, what are we actually talking about here? Well, swing trading is a medium-term strategy. Instead of holding for stressful minutes or holding for decades like a retirement fund, you're holding your positions for days or weeks. The goal is super straightforward. Capture a meaningful chunk of a larger market move. Because markets literally never move in straight lines, right? They move in waves or swings. As a swing trader, your job is to identify that broader trend, wait for a swing to form in your favor, hop on, ride the momentum, and then gracefully hop off before the current changes direction. To get you surfing these markets like an absolute pro, we've broken this explainer down into a really focused 5-step roadmap. First, we'll look at the swing trading sweet spot. Then, we'll cover essential tools and indicators. Number 3 is core swing trading strategies. After that, we'll crunch the mathematics of risk. And finally, we'll conquer the ultimate battleground, mastering trading psychology. Starting off with Section 1, the swing trading sweet spot. I love calling it the sweet spot because it really is the perfect middle ground between the high-octane stress of day trading and the extreme hands-off patience of long-term investing. To put this into perspective, let's contrast it with day trading. Day trading is fast. We're talking minutes or hours. It requires massive amounts of screen time, but the major trade-off is zero overnight risk. You close out every single position before the closing bell. Swing trading, on the other hand, operates over days or weeks. It requires incredibly low screen time, maybe an hour a day after the market closes, just to review your charts. But here's the catch. You are taking on deliberate overnight risk. You're basically trading your time for the opportunity to capture multi-day momentum, which means you have to be totally prepared for the market to gap up or down while you're fast asleep. Moving right along to Section 2, essential tools and indicators. Look, if we're going to hold positions overnight and filter out all that daily noise to find our perfect wave, we need the right mathematical filters. We just can't rely on our gut feelings here. We need hard data. And this brilliantly illustrates what we call the Big 3 indicators. These basically form the foundation of most swing trading setups. First up, moving averages. Their superpower is identifying the overall trend direction, but their kryptonite is that they lag behind real-time price. Second, the RSI, or Relative Strength Index. This is fantastic for spotting when a stock is getting overbought or oversold. But watch out, it can totally give you false signals in a really strong trend. Finally, the MACD. This is your go-to for spotting major shifts in momentum. But it can absolutely whipsaw you with false signals if the market is just chopping sideways. The big takeaway? No single tool is a crystal ball. Since there's no magic 8-ball, the real magic of a swing trading strategy happens through something called confluence. Confluence is just a fancy way of saying multiple independent indicators all happen to agree on the exact same trade. But notice that very first point, combine 2 to 3 indicators maximum. Seriously, throwing 10 indicators onto your chart isn't going to make you a better trader. It's just going to give you massive analysis paralysis. A classic, highly effective setup works like this. Use moving averages to make sure you're trading with the trend. Check the RSI to ensure you're not accidentally buying at the absolute top. Use the MACD to confirm the momentum is actually shifting your way. And finally, always check trading volume to validate that the big institutional money is backing the move. All right, on to Section 3, core swing trading strategies. Our board is waxed. We have our tools ready. This is the action phase. This is how we actually paddle out and ride those market waves. Before we get into specific strategies, let's just walk through a classic swing trade life cycle so you know what to expect. On day 1, you spot your setup and you enter the trade. Now, jump to day 4. You are holding through overnight volatility. The price might have dipped a bit, the news cycle might be sounding scary, but your chart structure is holding strong. It isn't until day 8 that the momentum finally reaches your target and you exit. This timeline highlights the single most important requirement of being a swing trader: patience. You absolutely have to give the setup the time it needs to play out. Let's move to and see how this builds into our very first specific setup, the breakout strategy. Step 1. You identify a stock that's just been trading sideways for a while. It's basically coiling up and consolidating its energy in a really tight range. Step 2. You don't try to guess when it's going to move. You wait for it to aggressively break out of that range, specifically backed by high trading volume. Step 3. You enter the trade, but you immediately place a strict stop loss just below that breakout level, just in case it was a fake out. You're capturing the explosive energy of a brand new wave forming. Now, alongside breakouts, here are 2 other fundamental strategies you need to know. Trend following is essentially jumping onto a wave that's already rolling. Pullback trading, on the flip side, is waiting for a temporary dip within that larger uptrend. It's exactly like a surfer waiting for the water to draw back right before the next big swell. Whether you buy the breakout, buy the momentum, or buy the dip, notice the common theme here. You are always respecting the broader market current. But hey, what happens when the wave actually crashes? Now, combine that tiny risk with a strict 1-to-3 risk-to-reward ratio. When you structure your trades mathematically like this, here's the crazy part, which leads us to our final stop, Section 5, Mastering Trading Psychology. Because honestly, the true battle in swing trading isn't the stock chart on your monitor, it's your own mind. Psychology is critical to successful trading. Without the proper mindset, you will not prosper in your trading journey. Think about it, you can have the absolute best indicators, perfect confluence, and a flawless spreadsheet. Emotional discipline is basically your only true edge in the markets. So, how on earth do we actually achieve that kind of discipline? Here are a few actionable steps to find the calm inside all that volatility. First, literally name your emotion out loud before clicking buy or sell. Are you feeling FOMO, grief, fear? Just acknowledge it. Second, state your worst-case dollar loss aloud and genuinely accept it before the trade even begins. Third, anchor your stop losses to technical chart structures, not to your emotional pain threshold. Fourth, and this is absolutely huge for swing traders, set price alerts on your phone and then step away from the screen. Seriously, stop micromanaging the trade. And finally, keep a rigorous trading journal. Note not just your entry and exit prices, but write down how you felt. Swing trading really is a beautiful, sustainable model for wealth generation, but only if you respect the rules. It allows you to participate in market momentum without having to give up your entire life to stare at a glowing screen. You just need the discipline to manage your risk, the patience to let your setups actually develop, and the psychological fortitude to stick to your plan when things get choppy. So, I leave you with this. Are you ready to stop frantically fighting the whitewater and start patiently waiting for the perfect wave? Thanks so much for joining me on this explainer, and happy trading. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you.